Welcome to today's Explainer. We're delivering a purely data-driven, executive-level breakdown of the structural shifts that are completely rewiring the global crypto market as of August 26th, 2026. If you've been watching the tape lately, you already know we are in the middle of a massive, systemic repricing. But to figure out exactly where we're going, we have to completely tune out the noise and focus purely on the cold, hard, analytical data. Let's dive right into it. $77.39 billion. Let that number sink in for a second. That is the massive, cumulative, short liquidation figure that just violently flipped the entire market upside down. And listen, this wasn't retail traders randomly buying the dip. Not at all. This was a sophisticated, mathematically driven short squeeze triggered by a sudden, massive macro liquidity shock. We saw an absolute obliteration of short positions as Bitcoin just blasted right past that $77,000 mark. So how exactly did we get here? And more importantly, where is all this institutional capital flowing next? Here's our analytical roadmap for today. We'll be covering the shock and the shift, the blind spots, spot demand and institutional flows, the new paradigm, and we'll wrap it up with a concrete action plan. All right, Section 1, the shock and the shift. So back in mid-August, the 10-year U.S. Treasury yield pushed past 4.7%, which basically choked off liquidity. But then, the U.S. Treasury suddenly doubled its long-term debt buybacks, going from $2 billion up to $4 billion per session. This instantly drove the 30-year yield down from a 19-year high of 5.34% to 5.19%. Now, why does this matter to crypto? Well, a sudden drop in yields significantly lowers the opportunity cost of holding a zero-yield, mathematically scarce asset like Bitcoin. Essentially, the macro liquidity tap was turned back on, and it unexpectedly flipped the crypto market's duration exposure overnight. That yield drop hit a market that was wound incredibly tight. The short-term holder cost basis had dropped to $68,500, which was well below the true market mean of $75,800. This is your classic, grueling capitulation setup, where sellers are just completely exhausted. The exact moment that interest rate trigger was pulled, the market absolutely exploded. We saw $1.26 billion in long leverage flood into the market in literally 60 seconds. This mechanical force shattered the 200-day moving average at $69,000, giving us a nearly 24% weekly surge to reclaim $77,000. Moving on to Section 2, the blind spots. An absolutely crucial point here is understanding where the money actually went. Analytics firms like CryptoQuant were sounding the alarm, claiming that a $15 billion drop in stablecoin market cap meant liquidity was bleeding out of the crypto ecosystem. But that was a complete illusion. In reality, following the 2025 Genius Act, which really reduced the appeal of non-yield-bearing stablecoins, smart money didn't leave crypto at all. They just rotated that $15 billion into yield-bearing real-world assets, or RWAs, like tokenized U.S. Treasury funds right on-chain. The liquidity didn't vanish, it just evolved. And it wasn't just data misinterpretation, we're talking about heavy positional bias. Market maker Wintermute was aggressively publishing reports citing minor ETF outflows and minor selling as reasons to be deeply bearish. However, what they masked was their own massive vulnerability. They were sitting on a $190.77 million short position, heavily concentrated in assets like XRP and Ethereum. They were entirely offsides for a liquidity shock, and their own bearish narrative ultimately set them up to become the primary victims of that subsequent short squeeze. This kind of bias is exactly why we're seeing such wildly polarized year-end targets right now. You've got Bernstein projecting $150,000 based on structural ETF demand, and Standard Chartered holding a neutral bullish $100,000 target. Conversely, you have firms like StoneX calling for under $60,000 because they're rigidly adhering to outdated 4-year halving cycle models and completely ignoring these localized liquidity injections from the Treasury. Frankly, if you're solely relying on historical cyclical models today, you are completely missing the new liquidity reality that's driving the tape. Section 3, spot demand and institutional flows. So we kicked off with a purely mechanical short squeeze, over $7.7 billion in shorts totally wiped out. But unlike the failed breakout attempts we saw earlier this year in May, this squeeze seamlessly handed the baton over to real persistent spot buying. We tracked massive spot ETF inflows ranging from $1.1 billion up to $1.92 billion for the week, and that's heavily driven by institutional vehicles. This is real, unleveraged money absorbing the newly created supply vacuum. Now, while Bitcoin definitely led the charge, Ethereum is going through this extreme mathematically verifiable supply shock. We saw $697 million in weekly ETF inflows, hitting a network where a record 32.4% of the entire circulating supply is locked up in staking contracts. That means it's completely removed from the tradable market. Meanwhile, liquid exchange balances have plummeted to a low of 14.9 million ETH. When you have nearly $700 million of Wall Street demand colliding with historic supply scarcity and heavy corporate treasury accumulation, the result is disproportionately explosive price action to the upside.
Which brings us to Section 4, the new paradigm.
Just take a look at this timeline of events that all hit within days of each other. The SEC proposes new, customized crypto regulations. The Clarity Act puts pressure on Congress. And then, on August 26th, major legacy exchanges Bitmart and BitMEX announced shutdowns and trading limits. Think about it. A year ago, this combination would have triggered a catastrophic sell-off. But today, whales actively bought into the news. The market is interpreting these closures not as contagion, but as institutional sanitation. It's cleaning house to prepare for a fully regulated, compliant future. The bad news is good news. Paradigm has officially arrived. And this new paradigm? It's causing a violent decoupling from traditional assets. As the Nasdaq fell 2.41% and the S&P 500 dropped 1.37% due to tech sector sell-offs, Bitcoin surged almost 24%. It is completely breaking traditional asset correlations. Institutional desks aren't trading crypto as a high-beta tech stock anymore. They are beginning to treat it as a debasement board hedge. Basically, an asset that protects against the devaluation of fiat currency. It's acting as an independent alternative asset class, fighting against fiat inflation and macro uncertainty. Finally, Section 5, the action plan. All right, based on the cold, hard institutional flow data, here is the recommended portfolio weighting for fund managers today. You want to be overweight on Bitcoin at 55%. It is the clear market leader with the most robust structural ETF demand. Ethereum should sit at a neutral 35%. It's highly attractive because of that supply shock we talked about, but it's still acting as a beta play to Bitcoin's dominance. And you absolutely must be underweight on altcoins at a maximum of 10%. A lot of the altcoin data is currently being distorted by artificial metrics rather than organic demand. Let's break down the specific technical parameters for these allocations. For Bitcoin, the data-driven target is $82,700, with a hard support floor established right at $66,900. Ethereum is targeting $2,800, supported at $2,395. Now, a very strong word of caution on Solana. While it boasts over $1.2 billion in cumulative ETF inflows, our on-chain data shows that roughly 37% of that is actually just issuer seed capital. That artificially distorts the real demand profile, which is exactly why it remains an underweight recommendation with a target of $128.
So here is your exact step-by-step execution protocol. Step 1. Use any market volatility to maximize your Bitcoin spot long positions, accumulating near that $66,900 support level. Step 2. Treat Ethereum strictly as a high beta asset. Its true explosive potential is going to unlock once Bitcoin clears its own upper resistance. And step 3, strictly control your speculative altcoin exposure. Don't get lured in by the noise. Wait for organic institutional flows into these new market wrappers to prove true demand in the alt sector before you increase your weight.
We've looked at the data. The liquidity has rotated, the supply is mathematically constrained, and the institutional rails are fully built. The market has left the capitulation phase and entered a structurally supported breakout. So I'll leave you with this final thought. Is your portfolio properly weighted to ride this massive institutional liquidity cycle, or are you still risking capital by trading on outdated market illusions? It's time to align your strategy with the structural reality of the tape. Thanks for joining me for this explainer, and I'll catch you on the next one.